For Morningstar, I'm Jeremy Glazer. In a speech this week, Fed Chair Janet Yellen expressed some caution about further rate increases this year. I'm here with Bob Johnson, who's our Director of Economic Analysis, to see if this caution is warranted. Bob, thanks for joining me.
Great to be here today.
Let's start with the speech. It obviously moved the market higher, but do you think that she's underestimating some of the risks, particularly to inflation in the U.S. economy right now?
I think they are, and certainly her speech was tame, and it certainly calmed markets and certainly caused a little bit of a run in prices as everybody said, oh, well, she's not planning to raise rates immediately. But I do think that they're thinking everything's kind of fine and the economy might be a little bit dicey is probably not the right analysis. I think inflation appears to be heating up, and sure, a couple of the consumption numbers looked a little weak. We can talk about that. But I really think that the economy is stronger than they're thinking, especially here in the U.S., and that inflation is running perhaps higher than they think it is.
Well, let's look at some of that data then that we have this week. That consumption number was disappointing, some disappointing revisions to previous data. What did it show us about the strength of the consumer?
Yeah, it showed us that the January number was revised sharply downward, but we knew that might happen because the retail sales report was revised down sharply. And recall there was a lot of things going on. There wasn't much utility usage because it was such a warm winter, and that's a big number in the consumption calculation, and certainly that weighed on it. Some of the auto data, some of the clothing data weighed on it. Clothing because, again, the weather, autos because of seasonal factors. So we really think that the consumption numbers that looked a little bit weak, even when you combine the first 2 months of the year, were not as weak as they look, and again, those are the kinds of things when we have anomalies that can bounce back in a single month, and it's all of a sudden, oh, yeah, we grew 3% in another month, and then you average out and you look pretty good.
So we had some caution there, but in housing, there was some good news.
Yes, the pending home sales has been like a key indicator of the housing market, and especially existing home sales. And existings didn't look so good a couple of weeks ago. But the pendings kind of relieved some of those worries because the pending data has been relatively steady in a very tight band for the last 5 or 6 months, kind of between 106 and 109, and right now we're at the high end of that at 109. And existing homes have kind of been all over the place as we've had problems with paperwork and weather, and a couple of other factors have kind of played with the numbers a little bit. The fact that pendings have been so consistent and now at the higher end of their normal band seems to suggest to us that isn't falling apart. If anything, that seems to be strengthening, and that's probably a better gauge than some of the existing home data we've seen lately.
Housing is looking stronger. How about employment? We got a preview of Friday's report with the ADP numbers, 200,000 jobs added. Is that about what you'd expect right now?
It is. As a matter of fact, I mean, that's the private sector number, but I think even when you add the government in, on Friday's report, from the official government report, we'll probably also see about 200,000 jobs. I think that's a consensus estimate, and that's where we're at. And, we kind of get there in that we had a very strong month in February above expectations at 242. 12-month averages have been about 220, 222. And so I think we're going to come back to average this time around, and we'll undershoot at about, say, 200,000. And when you average the 2 months together, you'll get to our average of 220 or so thousand jobs added. So, and that number is relatively consistent with kind of the 2 to 2.5% GDP growth. So I think the numbers are beginning to fit together, and we're pleased to see that the employment numbers are looking good, because I think, although I've railed against those numbers as being coincident or maybe even lagging, the jobs added is relatively concurrent. It's the unemployment rate that is kind of the lagging one of the batch. And I think that the fact that they've been so relatively stable for many months here seems to indicate to us that the overall underlying strength of the economy is pretty good. We've got weather, we've got inventories, we've got different financial shocks, we've got oil prices jumping around. All those things that are moving some of the data around. But to see underlying employment growing at this kind of relatively consistent rate seems to indicate to us that the economy is pretty steady.
So you see maybe some of the steady or good data from some sectors. What would you be looking at then in terms of inflation, where you'd start to really get worried? What's going to be on your radar screen there?
Yeah. On the inflation front, we're deeply worried about the services sector, which has got inflation, according to the CPI, well over 3%. not well over, but 3.1%. And so I think that's certainly a problem area. Anytime you get near 4% on anything, that's a real danger sign, and that's when you've got a real problem. I don't think we're there yet, but I think you do have to worry. And certainly gasoline prices, we were just checking this morning, were up about 11% in March after a substantial month down in February, kind of offsetting each other almost. And even when you adjust for the big seasonal factor, which was a huge one in March, the 11% hike still translates into a 3% seasonally adjusted hike, which is something we haven't seen for a little bit. So that's certainly something that's going to weigh on the headline inflation, not just and maybe some of the people will pay more attention to core when they see the headline number as strong as it's going to be.
Well, Bob, thanks for your take on this day today, and we'll talk to you on Friday when we get those official numbers for your read on that report.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.